You know, everyone's chasing the next big thing, AI, crazy tech stocks. But today, we're going to do something a little different. We're going to talk about a company that's been around for over 120 years, and all they do is bottle soda. Yeah, soda. Stick with me, because what sounds kind of boring on the surface, it might just be a brilliantly strategic investment.
So that's really the big question, right? In today's market, does it actually make sense to put your money into the company that just, puts Coke into cans and bottles? I mean, is there really any growth left? Is there any value in a business that's this old?
Okay, so to give you a sense of the sheer scale we're talking about, think about this number 60 million. That is how many people Coca-Cola Consolidated serves. We're talking 14 states plus DC. So, yeah, this isn't some small regional bottler, it's an absolute logistics monster.
All right, now this is super important to get your head around. Coca-Cola Consolidated, they don't actually own the Coke brand. They don't have the secret formula locked in a vault somewhere. That's all the Coca-Cola company, the parent. What these guys own is the muscle. The factories, the warehouses, the massive fleet of trucks. They are the largest bottler in the US. They're the ones who actually get the cans and bottles onto the shelves. Think of them as the powerful engine behind the iconic brand.
So, the big question is it a buy? Well, to figure that out, we're going to break this whole thing down. We'll look at its competitive advantage, what investors call a moat. We'll dive into the numbers to see what story they tell. We'll check out the leadership's game plan, and of course, we've got to look at the risks. Let's get into it.
Okay, first things first. Let's start with the absolute foundation of this whole investment case, which is just how incredibly dominant these guys are in their market. So here's the entire thesis in a nutshell. For, forever, this company has been a super reliable cash machine, just riding the coattails of the powerful Coke brand. But, and this is a big but, some recent strategic moves have thrown a whole new layer of risk and reward into the mix. It's gotten a lot more interesting.
So you gotta ask, how does a company last for 120 years in a business like this? Well, it all comes down to something Wall Street loves to talk about, an economic moat. Basically, it's competitive advantage. So for these guys, just how deep and wide is that moat really? Yeah, so a moat is just a fancy way of saying a business has a way to keep competitors out and protect its profits for the long haul. And the analogy here is pretty perfect. Think of it like this. Within their territory, Coca-Cola Consolidated owns all the toll roads, and Coke is the most popular car in the world. So if you're a grocery store in their region and you want to sell Coke, guess what? You have to pay their toll. There's no other way. And what's really cool is that their moat isn't just one thing. It's built in layers. First, you've got the untouchable brand power of Coca-Cola itself. Nobody can compete with that. On top of that, they have franchise exclusivity. That's basically a legally protected monopoly in their regions. Then you add their insane distribution scale. And all of that together, it creates this powerful customer lock-in. I mean, come on, can you imagine Walmart just deciding not to sell Coke? Their customers would go somewhere else. It's not going to happen. Now let's look at what they're actually selling. You can see here, sparkling drinks, the classic sodas, are still the biggest piece of the pie at 59%. No surprise there. But check out still drinks. We're talking water, sports drinks, teas. That's almost a third of the entire business. So this really shows they're not just a one-trick pony. They're diversifying way beyond just the bubbly stuff. Okay, so the business model is clearly solid. It's a fortress. But does it actually make good money? For investors? Let's follow the money and dive into the financials. And this, right here, is where things get really interesting. For what's supposed to be a boring old company, their profitability has just exploded. Take a look at this chart. A decade ago, their operating margin was hovering around 9%. Today, it's over 13%. That's a huge jump. It means they are getting way, way better at squeezing more profit out of every single can and bottle they sell. So wait a second. How is that even possible? How are they getting more profitable if they're actually selling a little bit less stuff? Well, this right here is the magic formula. You can see that in 2024, their sales volume, the number of cans, actually went down a tiny bit. But look at the revenue. It went up almost 5%. That is what we call pricing power. It's the holy grail for a business. The ability to charge more without people stopping to buy your product. And that is a huge sign of strength. Behind all these numbers and charts, there's a really fascinating human story. This isn't some faceless corporation. It's been run by the same family for 4 generations. And that family just made a massive, multi-billion-dollar bet on themselves.
If you look back at their history, you can see this really clear pattern. It's like a three-act play. In the 80s, you had this wild, aggressive expansion. It was go, 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 until they hit a wall with that whole new Coke disaster. Remember that? So Act Two was all about cleaning up the mess, modernizing, and getting disciplined. And all of that just set the stage for the current CEO, J. Frank Harrison III, who kicked off this incredible era of growth. He started buying up more and more territory from the parent Coca-Cola company and has quadrupled the size of the business since he took over. So if we were to give the current management a report card, what would it look like? Well, you can see here they get top marks for strategy and for just running the business day to day. Super strong. But then you see these fair ratings. What's that about? Well, financial management gets a knock because they've taken on a ton of new debt. We'll talk more about that in a sec. And stakeholder communication is just okay because honestly, they're pretty quiet. They don't do a lot of public calls or communicate much with investors. They like to keep things in the family, so to speak. And that debt, it leads us to the single biggest move this company has made in decades. They dropped $2.4 billion to buy back all of the shares that the parent Coca-Cola company owned in them. This was basically them saying, we're cutting the cord. It was a declaration of independence, a massive bet on their own future, giving them total control to run the show exactly how they want to. But look, no investment is ever a slam dunk. And a huge, bold move like that, well, it definitely comes with its own set of risks. So we've got to be clear-eyed about those. Let's put them on the radar. First up, customer concentration. This is a big one. Check out this chart. Almost a third, nearly 30% of everything they sell goes to just two companies, Walmart and Kroger. Now think about that. When just two customers make up that much of your business, who do you think has the power in that relationship? It gives those giant retailers a ton of leverage. Risk number two. Remember that massive share buyback we just talked about? Well, they didn't pay for it with cash. They used debt. And this number, $3 billion, that's the new debt they're carrying. Now, for a business that spits out cash like this one does, it's probably manageable. But let's be real, it adds a whole new layer of financial risk that simply wasn't there before. And it doesn't stop there. There are a few other big things to keep an eye on. One, they're completely tied to the mothership, the Coca-Cola company, for their products. Two, the cost of stuff like aluminum for cans keeps going up. And three, the big one, people are slowly but surely drinking fewer sugary sodas. Okay, so we've looked at the powerful moat, the impressive numbers, the bold family leadership, and the very real risks. It's time to put it all together. Let's land the plane and answer that question we started with. So here's the final weigh-in, the pros versus the cons. On the pro side, you have that incredible, durable moat and pricing power. You've got a management team that knows how to run this thing like a well-oiled machine. And you have family leadership that has all its skin in the game. But on the con side, they're not really selling more stuff year over year. There's definitely more debt and financial risk now. And as an outside investor, your voice is pretty much muted by that family control. So what's the bottom line here? Look, Coca-Cola Consolidated is what you'd call a classic defensive play. This is not a stock that's going to give you that explosive, high-flying tech growth. It's just not. What it offers instead is stability, consistency, a certain kind of predictability. So really, you could say it's an investment that's as reliable and, for the right kind of investor, just as satisfying as an ice-cold Coke on a hot Carolina afternoon.